Hello, I'm Julian Whittle from Cumbria Chamber of Commerce, and I'm here with Sir Jon Cunliffe, one of the Deputy Governors at the Bank of England and a member of its Financial Policy and Monetary Policy Committees. We're recording this podcast in Kendal, where Sir Jon is addressing a chamber lunch. Sir Jon, welcome to Cumbria.
Thank you very much.
The last Monetary Policy Committee meeting voted by 6-3 to keep the base rate at 0.5%. You were one of the 6. Without breaking any confidences, can you summarise the arguments on the MPC for and against a rate rise?
So the Monetary Policy Committee's last forecast was in May. We'll be making another forecast in August. We'll start on that, working on that next week. And I think we always have to sort of process the latest economic situation and see what's happening. But the committee's forecast in May was for growth in the UK economy of above 1.5%, for gentle inflation pressure to start domestically, and it was based on a market interest rate path, which included interest rates rising by 0.75%. Now, we don't know whether that will happen or not. We also had a very weak first quarter.
Yeah.
We had a lot of snow in the economy. But we also had a drop in retail sales, drop in consumer demand for credit, and drop in consumer confidence. And I think for the committee, with the May forecast in mind, they wanted to see whether economic developments had, if you like, filled in with that May forecast. And clearly the first quarter of the year hadn't. So for some members on the committee, they felt the May forecast required a quicker increase in rates. Other members of the committee thought that they would wait to see the evidence from the first quarter and to look again at the issue in August.
Okay. Would you agree, though, that the interest rates are something of a blunt instrument for controlling inflation? I mean, they may work well if inflation is caused by an overheating economy, but the inflation that we're seeing is mainly being caused by the weakness of sterling.
So the bank's objective is to have inflation at 2% and to have it at 2%, not above, not below, and to have it at that rate at all times. I think when you are faced as a domestic policymaker with inflation that's coming from abroad, I mean, clearly you can't affect the conditions that happen abroad, but you can affect the overall level of inflation in the economy by monetary policy action and by using interest rates. The question you have to ask is this inflation, when it's coming from abroad, is it coming from abroad, or will it pass out of the system relatively quickly?
Yep.
Because interest rates work with a 12 to 18 month, 18 to 24 month lag. So if I take action now to deal with something that's coming from abroad, by the time it's working, well, the thing that I'm trying to deal with has gone away of its own accord. But also you have to think of what's happening in the underlying economy. So if you have an economy that has a lot of spare capacity, a lot of unemployment, I think, and then you have inflation, but it's coming from abroad, you don't really want to use interest rates to push down on the domestic economy, which is already weak. You know, there's a trade-off, and if you think the inflation from abroad will move out of the system, you might want to wait. I think that's very much what the Monetary Policy Committee did before my time in 2010, 2011. The last point, and this hasn't happened in the UK, and I think part of it is to do with the fact that 2% inflation has become credible, and I hope because the Bank of England has become credible, but we certainly saw it happen in this country in the 70s, is that if you get large inflationary pressure, say from abroad, and people start to see inflation above 2%, they change their expectation of inflation. They start to assume it's going to be 3%, not going to come back down again, it's going to go up. And those are the spirals we saw in the 1970s. So in central banker terminology, if inflation expectations become unanchored, if they start to move, if people stop expecting inflation will come back to target but will go up, they'll act as if inflation is going to go up, they'll ask for larger pay increases, they'll put prices up, and then you get into some of those spirals. So when you're faced with inflation from abroad, you do have to look to see if inflation expectations are anchored, and that those external impacts are not just starting to work into the domestic economy. But at the moment, inflation expectations do seem to be anchored.
And when rates do rise, and obviously they must at some point, do you see them ever returning to the sort of long-term average of 5 to 6%? Or has there been a seismic change? Are we in a new environment of permanently low rates?
So first, ever is a long time. I'm not sure I can do ever. And it's not the historical average, it's the average. 4 to 5% is the average from the mid-90s to the crisis. I grew up in an era when interest rates averaged 12, 15%, and some people can remember even higher ones. I think what has happened is two things in the UK. One is, I think we have, and I say this not just because I'm on the Monetary Policy Committee, but I think we just have a more credible commitment not to have inflation in the country. We have more credible machinery, the bank, the Monetary Policy Committee, which means that expectations don't get out of hand and actually interest rates don't have to be that high. And the other thing that's happened is more of a global thing, that over the last 20, 30 years we've seen not the short-term interest rates but long real-term interest rates go down in the world generally, partly because of demographics, partly because of emerging market countries and income distribution, and partly because productivity has gone down. And those are longer term forces, and they won't go away quickly. I mean, ever, as I say, is a long thing, but for
the foreseeable
future, I don't see us getting back to the 4 to 5%, nor do the financial markets. So interest rates, I hope, will increase over time, because if they do, they increase. I hope they increase because the economy is healthy, but as we've said, they'll increase to a limited and gradual extent.
I mean, you mentioned the slow start to 2018 with growth was only 0.2% in the first quarter, but there are signs that the economy is, the latest data, that it's picking up. What do you see as the main threats to growth in the short to medium term?
So I think on the UK economy, we're growing roughly in line with the potential power of the economy. We were worried in the first quarter of the year that something had changed consumer behaviour, that there'd been a shock to consumer confidence. That seems to have recovered. People talk about whether Brexit shocks may affect consumer confidence and the like. They may do. Of course, the opposite may also happen, that if there is a resolution and a deal, that confidence increases. And then at the moment, the UK economy is being supported by strong world growth, and I see that continuing. But clearly, if you've got events in other countries and possibly longer term concerns about trade and trade wars, that will impact us through the foreign channel.
Okay. Insofar as consumer spending has held up, it's in part at least because people have dipped into their savings, and that isn't sustainable long term, is it?
So it's clear that you can't. If you keep dipping into your savings without replenishment, it's eventually you run out of savings. They dipped into their savings because real incomes were squeezed, and real incomes were squeezed because pay increases have been pretty muted in this country for the last 10 years. So pay growing at around 2%, inflation above 2% because of the imported effect. That's a squeeze on real incomes. I think a lot of the dip in savings that we saw were people compensating, smoothing through that. Longer term, can it be sustained? The question is, will it need to be sustained? So in the Bank of England's forecast, pay grows by 2.5% and then starts to move towards 3 and above 3. Inflation is already coming down. People are now seeing for the first time last few months real pay increases, because pay growth at 2.5% is above, has been above inflation. And as that continues, I think there'll be less need to do that, and actually people may decide to start to rebuild some of those savings. But the key to this, I think, is not the savings that people have. The key to this is how does pay and inflation, how do they evolve, and do people start to see sort of consistent increases in their disposable income?
I mean, one thing that's surprising me at the moment, at this point in the economic cycle, we'd expect to see businesses investing more, but that doesn't seem to be happening this time. Why do you think that is?
Investment in the UK is growing, so it has been growing for the last few years. It doesn't seem to be growing as fast as you might have expected, though. And when I look at investment rates in other advanced economies, and when I look at the conditions, the financing conditions for investment, the needs for investment, you have to ask. So one possibility, and there's some evidence for this that I picked up in Cumbria talking to businesses and others, and and our agents pick up around the country. Well, one possibility is that certainly for companies that are closely involved with Europe, they're holding off on investment decisions until they have more clarity on the European Union.
Final question. South Lakeland, where we are now, has the distinction of having the lowest unemployment rate in the UK. Employment has been falling across the country, and you'd expect that to lead to wage inflation. But it hasn't really. Average earnings are struggling to keep pace with inflation. Why is that, do you think?
Oh well, that is the £64,000 question, I suspect, and it's the question that, along with productivity, that we've spent most time on the Monetary Policy Committee discussing. And that question, why has pay not responded to very low unemployment, which in the past it would have done. I mean, at 4.2% unemployment before the crisis, we'd have seen much bigger increases in pay. And as an extension to your question, is it going to change? And I think there are a number of reasons for it. I think coming out of the financial crisis and the recession, there's been some scarring of the labour force. Certainly, not so much recently, but certainly going around the country, I used to hear a lot when I asked, what about a pay increase? They'd say, well, people are just happy to have a job.
Yeah.
And there is evidence that psychologically that can affect things. I think part of it is to do with just changes in the world of work, changes in moves from full-time to part-time, changes in contractual terms. I think it may also be, some have said that people are not taking pay increases, they prefer to take a holiday, they trade off time for money and the like. So there is, I think there are some big changes that have happened in the structure of the labour market. I think there are also some scarring effects from the recession that followed the crisis, and the question is, will we see more normal relationships assert themselves going forward? I think we are starting to see some of that, but there's quite a way to go.
Okay, thanks very much, Sir Jon.
Thank you.